So what I see is that we have the central banks have gone into this crisis altogether with the same kind of policies, but we see now that they will exit these strategies in a different pace. And indeed, this is, as the US is probably the country or the big monetary space who exited first and will and is doing better than the others, that could actually put pressure on regions that are doing less good than, for example, Europe, especially as the long-term yields in the US are also giving a global pace for yields in the world. We have seen also that with the rise in US yields, we had an increase in European yields. So also here, a bit of a tightening of financial conditions at a moment where Europe is in a more fragile situation. I think this makes the job for the ECB not easier, but in a way, the comments yesterday from Chairman Powell also show that the Fed is very well aware of its international responsibility in this recovery. So it makes the thing for the ECB not easier, but I don't expect it to be totally disruptive either.
Patrick, then, so what's the message for those who might want to dabble in the bond market watching these yield moves? Is there a risk here of further intervention from Powell, say Operation Twist and yield curve management?
Yeah, what I think is we have to look at what is actually priced in the yield curve. And there's a lot of talk about market expectations of inflation and so on. But we did the analysis and we saw that actually what was priced in was more the uncertainty or the risk element in the yields. And these risks are related to temporary overshoot inflation and also a rebalancing of the supply and demand in long-term US Treasuries. So in that case, this repricing of this, especially of the supply and demand of US Treasuries, which is embodied in the term premium, what we call it, is something that was expected in a way. So this repricing of the long-term yields is something that is in line with these changes of funding strategy also in the US. If you want to see what's happening on the US bond market, I think don't focus too much at the long end of the curve. The music currently is on the short end. I don't know if you are aware, but many of the very short rates in the US money market rates are trading very close to zero. We have the SOFR or the overnight repo rate just trading above zero. So we have this situation where we have the US yield curve being stretched on the long end and on the extremities of the very short end. And I think the Fed made very clear yesterday that it's a total priority to keep the short-term funding market functioning. And if there is, for example, one of these rates going into negative territory, pulling down the effective Fed funds rates, then you would expect interventions on the Fed, but on the short end of the curve. So maybe that's a message I want to convey. The short end of the curve of the US is currently where the music is playing.